Hey everybody, today we are going to be talking about options trading. What is options trading? What do I need to know before I get started? And how do I get started? I am going to walk you through everything that you need to know and the foundation of what is important in options trading. This is your beginner's guide to options trading and how to get started. So let's just get on into it. Let's start out with the basics. What is options trading? By definition, options trading is a contract that gives the buyer the right, but not the obligation, to buy or sell an asset at a specific price on or before a specific date. That is the definition, and I know it's a lot, but we are going to break that down much more and simplify that. You can think of options like coupons. With a coupon, that gives you the right, but not the obligation, to buy something at a certain price or discount that the coupon offers on or before the expiration date of the coupon. So just think of an options contract like a coupon. A standard options contract is worth 100 shares of the underlying asset. And these underlying assets can be stocks, indexes, ETFs, a bunch of different things. So if you have two contracts that you purchased, you have the right, but not obligation, to control 200 shares of that underlying stock. Now let's get into the basics and the core foundation of options trading. All right, so in options trading, you have options contracts. And the contract is what you can think of like the coupon. That contract is made up of different things, so we're gonna go through all of those right now. You have your underlying asset, which, like I mentioned, this is the security such as a stock, ETF, or index that your option is based on. You also have a strike price. And this is the predetermined price that you choose that you can either buy or sell the underlying asset as. With options trading, our goal is to get in and out of these trades before we have to buy or sell the underlying asset. So the strike price is pretty much where you expect price to go on your chart. You can think of the strike price like the discounted price on your coupon that is offered. So if you have a coupon saying that you can purchase a pair of shoes for $100 when they are currently retailing for $150, that is your strike price, that $100. Options contracts also have an expiration date, which I mentioned that this is the date that you have to either close your position or you will be something that's called exercise, which we'll get into a lot more later. But basically that means that you will have to purchase the shares or your option will expire worthless, depending on what price it expires at. The most important thing that you need to know about the expiration date is that typically we are looking to close our position before that date because we do not want to have to purchase the shares. We just want to make money off of the contract, increasing in value. So expiration date, most important, that's the last day that you can close your position. Make sure it is closed before. Kind of like a coupon, the expiration date of the coupon is the last date that you can purchase whatever it is at that discounted coupon rate. You also have the premium, which the options premium is how much you are paying to buy into that options contract agreement. This is also how you are going to determine your profit and risk amounts. In options, you make money off of that premium rate. If the option goes up and your premium increases in price, you're going to make money. If it does the opposite and it goes down and your premium decreases in value, that's when you can lose money. The amazing thing about options trading is that you only have the ability to lose how much premium you buy into. Your risk is capped at however much you buy into on the premium. So whatever premium you pay is the most that you are able to lose in an options trade. Now I mentioned that with an options contract, this allows you to control 100 shares of the underlying stock. So when you have your premium price, you need to multiply that by 100, and that is how much money you are spending to buy into the options contract in your trade. So for example, if your premium costs $2 per contract, per position, you need to multiply that 2 times 100 to get $200. So on an options trade that costs $2 of premium, each open position is actually going to cost you $200, and that is how much risk you have in that trade as well. The options premium is kind of like a Groupon, where when you buy into a Groupon coupon, you are going to pay a certain price to be able to get a service at a discounted price. So the premium price is the price that you pay to receive that coupon or discount code. Options also have something called the Greeks, and these are something that can be very complicated, but for now we are just going to keep it nice and simple and go over the most important things that you need to know. The Greeks are what you use to help measure the options price movements, and this is all how we make money in the market. Your delta is going to tell you how much the options price moves in relation to the stock price. So if the delta is a delta of 0.5, the premium price, which is how we make our money and how much we paid to get into the contract, moves about 50 cents for every $1 move in the underlying stock. Okay? So let's break that down a little bit more. If your delta is 50 cents and you pay $2 for your options premium, and the underlying stock, let's just say we bought Apple stock, and Apple stock goes from 300 to 301. We increase by $1 and we are in a call buy position. So we are looking for that stock to increase. As Apple increases, our $2 premium that we paid now is going to cost $2.50, which means our contract just made 50 cents of premium, which is profits, and you have to multiply that by 100, and you just made $50 on that contract. The theta is what measures your what's called time decay, and this is how much the options contract premium loses value over time. Options contracts are always going to lose value as we move closer to our expiration date, which is another reason why you want to just close that position before expiration. If the theta is negative 0.05, which is negative 5 cents, your options contract premium is going to lose 5 cents of value each day. Multiply that by 100, and that is losing $5 of value each day. So if you have that $2 premium on your contract and a day goes by, your premium is now going to be worth $1.95. Or when you multiply that by 100, $195. Whereas you started at $2 or $200 and you just lost that 5 cents of value because of what's called time decay. The most important thing about these Greeks to know is that they are going to affect your contracts more when you have contracts that are closer to expiration. I know this is a lot, and I know the Greeks are complicated, so we are going to dive much deeper into that in another video, but for now, this is the basics and the foundation of what you need to know. Don't overthink it, just keep it nice and simple. And I'm talking about all of these different options contracts, but where do you actually see and view the options contracts? These are viewed in something that's called an options chain. Each of your different trading platforms and brokerages will have access to their own options chain, but the options chain is a list showing all of the different options contracts that are available for a certain stock. This is where you can also choose your contract and buy and sell those contracts. This right here is what the options chain looks like on Thinkorswim, which is the trading platform that I use. Thinkorswim is operated under Schwab brokerage, but this is what it looks like. And as you see here, you have all of the different expiration dates. I have SPY pulled up in this example, and SPY is the ETF that tracks the S&P 500 index. So there are expiration dates for every day here because SPY and the S&P is very liquid and has a lot of volume. So these are the different expiration dates. If you were to drop down one of these contracts and click on that tab, that drop down tab, it is going to open up something that looks like this right here. And this is where you are actually viewing your options contract and the specifics that we went over on the last slide. Here, as you can see, this is my options contract. I selected the expiration date of March 14th, which at the time was 2 days away from when I opened this contract. And here you can see that for each of the different strike prices that we talked about, which again, the strike price is that discounted price that you purchase your coupon at. So the strike price in options is where we expect price to move to. So these right here that I'm hovering over are all of the different strike prices. If I choose 561, on the left-hand side, this is where I would be looking at calls which is your bullish movement, and we'll go into that in a moment. Here you can see the ask price, which is the price that I would pay, my premium price that I would pay to enter this options contract, as well as things like the delta and the theta that we discussed. This is all customizable depending on your preferences. On the right side of the chain, this is where you can view your puts, which is expected for bearish moves, which we are about to get into right now. Calls versus puts. This is where you actually get into the specifics on how to buy and sell options contracts. Call options give the holder, which is the buyer, the right to buy 100 shares of an underlying asset at the strike price before expiration. Whole lot of words, right? Call options are used when you expect the stock price to rise and increase, and this is called a bullish move and bullish market. Let's think of this in terms of our coupon to make more sense of it. With this coupon today, we are going to be buying sneakers. A call option lets you buy those sneakers for $100, knowing that they might increase and go up in value to cost $150. So you can use the coupon that you purchased for your call option to buy the sneakers at that $100, or you can resell them once the price of the sneakers goes to $150 and make profits. So with options, call options are used for bullish moves and when you expect price to increase. Put options give the holder, the buyer, the right to sell 100 shares of an underlying asset. So put options are used when you expect the stock price to decrease or go down, and this is called a bearish movement. So you can think of the put options like a store return policy that guarantees that you can return your sneakers for $100, even if the price on the sneakers goes down to $50. So you can sell the sneakers back at the original price, which is our strike price, and you will not lose any money. So put options are just used when you are expecting price to go down in a bearish market. When trading long options, we are always going to be buying into the contracts. So you are either buying an upward movement, which is a call, or buying a downward movement, which is a put. The next important thing with options trading is to understand what in the money versus out of the money is. So we're going to break this down real simple and make it as easy to understand as possible. Feel free to pause the video to digest any of this information as we go and just pick up once you've digested. So for in the money options, these are often represented as ITM. Call options, which is when we expect the price of the stock to increase, are when the stock price is above the strike price, okay? So if our stock price is $105, and we're still trading Apple here, if it's currently at $105 here, a $100 call option is in the money because our stock price is $105, which is above the strike price of $100, okay? For put options, they are in the money when the stock price is below the strike price. So back to our Apple example, our stock price is currently at $105, but we have a $110 put option. So our stock price of $105 is below our strike price of $110. And those are in the money, which is a good thing. In the money options have what's called intrinsic value. And this is pretty much the value of the option if exercised now. So all you need to know is that in the money options hold more value, hold more premium value, which we care about because that's how we make our money, okay? Out of the money options are often represented as OTM. And for call options, they are out of the money when the stock price is below the strike price. So let's come back over to our Apple example. If Apple stock is currently trading at $100, if our strike price is $110, okay, Apple price is at $105, which is below our strike price of $110, making it out of the money. For put options, they are out of the money when the stock price is above the strike price. So with our Apple example, we have a stock price of $105, which is above our strike price of $100 down here, making it out of the money. The biggest thing to know with out of the money options is that they have no intrinsic value. meaning that when your contract is out of the money, it is going to lose value faster, which is important for us because when our options contract loses value, that's how we lose money, and we don't want that to happen. So I know this is a lot to take in and a lot to digest, but you can think of in the money options like a super valuable coupon. Let's go back to that sneaker example. If the sneakers now cost $150, but you hold a coupon to buy them for $100 still, your coupon is very valuable and you could either save or make $50, and that means that your coupon is in the money, okay? You can think of the out of the money coupon like a coupon that is useless and doesn't hold any value. Let's say that the sneakers cost $100 right now. Let's say that the sneakers did not go up in price and they still cost $100, but your coupon is telling you you can purchase them for $100. Your coupon is useless and you can purchase the sneakers for the same price that you would have paid with the coupon. So that is considered out of the money. I know that this is a lot to take in, so just take it step by step. It takes time to perfect this and to really get a full understanding on it. But all that you need to know right now is that in the money options hold real value, and out of the money options only become valuable if the price of the stock moves in the direction that you anticipate. All right, so I mentioned something called exercising earlier, and this is not like you are going to work out. This is what happens when you use your right to buy or sell the stock at the strike price. So the most important thing that we need to know about exercising is that most traders do not choose to exercise their options. They just close out their position and sell their contract for profit before the expiration date. So if you do not want to have to purchase the underlying stock, that 100 shares or more depending on how many contracts you have, you just have to close your position before the expiration date and you will make a profit depending on how much your premium has increased. One key thing to note about exercising is that your option can only become exercised if it is in the money. So if your option expires at that expiration date out of the money, your contract will just expire worthless and you will lose the entire premium that you paid to enter into your trade. You can think of exercising just like when you use your coupon. Let's go back to the example where we are looking to buy sneakers. We have a $100 coupon. And let's just say that the price goes up to $150 of those sneakers. We will exercise our coupon and check out with those sneakers with that coupon code, and we will be able to purchase those sneakers for $100 rather than $150. But on the other hand, if we have that $100 coupon and these sneakers decrease in value to $50, we won't ever use that coupon and it will never be exercised. We'll just get rid of it and we lose whatever the Groupon amount was that we paid to get that coupon. Again, I just want to emphasize that this is just important to have an awareness to and know, but most traders trade for what's called speculation. So we just look to close our positions and not be exercised. We just want to make money on that premium profit. So now you are probably wondering, this is crazy, this is a lot. Why do people even trade options when you could just trade the stocks? Why make it more complicated? So why trade options? There are a lot of reasons why options are amazing. Number one is going to be leverage. Leverage allows you to control more with less money up front. So basically you can risk less of your own capital in order to have higher potential returns and gains. And why wouldn't you want to do that? So with our coupon example, let's start a new example and imagine that you have a coupon for $10, okay, for your sneakers, $10 sneakers. That's amazing. The store is giving you a special coupon that allows you to purchase up to 10 pairs of sneakers with that discount and flip them for profit. So you can now purchase 10 pairs of sneakers for $100 and flip them for profit when the sneakers actually cost $50 each, let's just say. Options let you control 100 shares of the underlying stock for a fraction of the price, which allows you to have bigger potential profits and put up less of your capital up front. Options also have that limited risk and defined losses that we talked about earlier within our premium. So in options trading, you can only lose the amount of money that you put up and pay for your premium. So let's just say we have an options contract for $2 and we decide to purchase 2 of those contracts, okay? So a $2 options premium needs to be multiplied by 100 because we're controlling 100 shares, and that would be $200, okay? We decided to purchase 2 of these contracts, so multiply that by 2, and we have a total amount in the trade of $400, meaning that if the trade goes completely backwards against us and we don't close out, we could lose maximum up to $400, which is a defined loss, and you can set and determine based on your account size, which is really helpful with trading. Risk management is everything. Options are also very versatile, meaning that you can use them to make money in all type of market conditions, whether it's bearish, bullish, or even neutral. You can buy options contracts and make money off of them. Lastly, options allow for very fast profits. Options are volatile, meaning that the price of the premium moves a lot faster than the price of the actual stock. So you can make a lot of money a lot faster than when just buying or selling stocks, but it does mean that it also comes with a risk in that volatility. But let's focus on the positives, and you can make a lot more money with options with those faster profits. In a minute, we are going to get into how to actually get started trading options and the next steps that you need. But first, I want to share with you my favorite learning resources and what has really helped me become a successful options trader and learn about the world of options trading. First, a really good book just to get started with at the very foundation and basics is Trading Options for Dummies. I love the For Dummies books because they break everything down really simply, and it does take time to get through the book, but you can kind of go at your own pace and select which topics you want to focus on. I also am a part of Traders Club Worldwide, which taught me everything that I know about options trading. Traders Club Worldwide is run by a professional trader who is a former Wall Street trader. He has been trading for over 25 years, and that is my coach in the Traders Club Worldwide community. So if you are looking to truly dive in and learn the skill of trading, options trading, and learn how to become profitable in the markets from a professional, I definitely recommend going ahead and getting started with Traders Club Worldwide. I am going to have the links to Traders Club Worldwide in the description of this video if you are interested in getting started. We made it. Next steps. What you need to do next is just get started. Let's just take the leap. Either get the book or join the team. Get going. The best thing that I would recommend to do to get started is invest in your education. Get the book, join a team, join a mentorship, coaching, community. That is so important when starting with trading. It is so helpful to be around other traders who are doing exactly what you're doing, and to even just be able to take their plan rather than spending years trying to develop and backtest a strategy and a plan. So investing in education is so important. After that, once you invest in your education, you are going to learn a strategy and create a trading plan. I recommend sticking with one strategy and one plan, one market when you are first getting started. You will also need to open a brokerage account, which this is where you deposit your money and withdraw your money as you are trading in the markets. The brokerage account is also linked to your trading platform, which is where you actually execute your trades and view your charts. I personally use Thinkorswim, and I definitely recommend Thinkorswim because it is a very professional platform. It is complex, but it has every feature and every ability that you could imagine, and that really sets you up to be a very successful trader. I am also going to be posting videos on how to get started with Thinkorswim. As I mentioned earlier, Thinkorswim is operated under Schwab, so you open a Charles Schwab brokerage account and then download the Thinkorswim trading platform. I will go ahead and post tutorials on how to open your brokerage account and a tutorial on the Thinkorswim trading platform. Lastly, once you've done all of that, it is time to start practicing with paper money. Trading is so cool because you can start trading and practicing without risking your own money. You can start in a simulated trading environment, which is using paper, play money, and actually taking trades in the real live markets and testing and seeing how it goes without actually risking your money. Once you do well with paper money, that's when you can fund your account with real funds and actually start making real money. So that is all that I have for you today for options trading. I hope that this was a very helpful beginner tutorial and covered everything that you need to know. I know we went a little bit in depth, but that is important. Options trading is complicated and does come with risk. So although we like to simplify it and make it as easily understandable as possible, it is important to get a solid foundation, and this video does just that. I am going to drop some links below to help you get started on the next steps in your options trading journey. And in the next video, I am going to go over how to open your Charles Schwab brokerage account so that you can get started trading on the Thinkorswim trading platform.